The world economy has been on the verge of collapse for quite a while now, and it's only a matter of time until an economic downturn occurs. Experts like Robert Kiyosaki and George Gammon share their opinion on how everything might go down and shed light on certain misconceptions about inflation. Join us in today's video here from these financial experts and gain insight into the inner workings of the upcoming economic recession. According to the Wall Street Journal, experts are generally predicting that a downturn is unavoidable as the Federal Reserve raises interest rates at the quickest speed in 28 years to tackle rising inflation. Many major Wall Street firms are now urging that their investors take advantage of the slump by purchasing defensive equities that have high returns on capital and strong dividends, particularly in industries such as utilities and consumer food staples. However, there are some financial professionals who believe that real estate is a safe place, and others who believe that holding precious metals like gold and silver will save them. George Gammon, host of the show The Rebel Capitalist, and Robert Kiyosaki, author of Rich Dad Poor Dad, talked about these issues. Robert Kiyosaki and George Gammon also talked about the severe recession the world is experiencing and how you can get through it. George Edward Eman is a successful businessman and real estate investor based in the United States. Since retiring at the age of 38 from his successful business career, George has concentrated on real estate where he has completed 40% of his purchases and renovations in the United States and abroad. He has recently been concentrating on Medellin, Colombia, where he has a real estate portfolio that is worth multiple millions of dollars and is focused on purchasing foreclosed homes, renovating them, and then selling or renting them. It is therefore in your best interest to pay attention to what these industry professionals have to say when they discuss the matter.
If they don't see the world the way it really is, they assume that the solution or the solutions that are presented to them by the central planners and the politicians.
Correct.
They just take that at face value. Is that, the solution for bridging the inequality gap, if you will, is just to tax the rich. We'll just take everything from the rich and we'll just let the politicians take what they want and then just give the table scraps to the poor, and somehow that will reduce the wealth gap. But as Margaret Thatcher said, that'll just make everyone equally poor. What we want to do is we want to make the poor and middle class, we want to make them richer.
Correct.
And for whatever reason, it's because those people don't have that financial education that you've been talking about for the last 30 or 40
Correct.
years.
You don't get it at school.
Yeah, they assume that the way that you again, bridge that gap is by taking from one group. So somehow there's like this fixed pie, and we have to realize that in free market capitalism, that pie continues to grow and grow and grow, and that brings up the quality of life for the people to buy.
But our schools say to go to school, get a job, and get a 401k. I'm going, gag me. I mean, I would never do that.
Yeah.
But if you had bad teachers or poor teachers, or your parents said, that's what you do.
Yeah, but even that in and of itself is a horrible argument. You just invest in the stock market, your 401k, because what happens is these financial planners, I'm sure you know this, yeah, exactly.
Who stole my pension, my 401k?
Yeah, but see, this is very important, because what the game these financial planners play is they only show you charts going back to 1981. And this is when Paul Volcker raised rates. So since then, we've been in a down cycle in interest rates. And you can say the stock market always goes up, right, if interest rates are always going down. But what happens when interest rates start going back up? And usually the cycle is about 30, 40 years. So if you look at charts of the stock market going back to 1927 to 1980 or 81 adjusted for inflation, it was pretty much flat. But see, they don't tell you that.
Right.
They just cherry pick the data.
Of course.
They want to give to you in order for them to collect their fees.
But something even worse happening is the last crash was, let's say 2008, when the repo market reversed and all this stuff. And most of these financial planners and real estate brokers, all they know is a rising market.
Yeah, that's right.
Since 2008, we've been nothing, and happy days are here again because they kept dropping interest rates. Real estate went up, stock market went up, bond markets went up.
Yeah.
And we were just talking to Ralph Powell, and he said the problem with that is that the bull goes up the stairs.
Yeah.
The bear comes out the window.
Or I've heard the elevator, but the window. That's a little bit more dramatic, isn't it?
No, but Powell says when it comes, it's 4 months. Yeah. That's how fast this bear is going to go out the window. So anyway, so you invested in property. Where was your property?
In Kansas City.
Perfect place.
Yeah, and my objective might help some people kind of think about real estate or assets in a different way. The first goal that I had when I retired is just to look at my monthly expenses and say, how can I get my money to cover those expenses?
Yeah.
You see? And so how can I get my cash flow to cover these things? So then I know that I'm never drawing my savings down.
Right.
And I think it sounds easy and it sounds commonsensical, but very few people just kind of connect those dots and realize that if they can create enough cash flow with their portfolio to cover their monthly expenses, that is when you're financially free.
Yeah, that's a cash flow game. Out of the rat race, all this stuff, you got $10,000 a month coming in, you got $7,000 in expenses, $3,000 net, you're free.
Yeah.
And there's tax breaks for it.
Mm-hmm.
You get a 401k. I'm going, kidding?
Right.
But this is the challenge for that company. Like, I was listening to Dalio and all the very smart guys, but they're all stock. You always say, get a diversified portfolio of stocks, bonds. I don't think any. I mean, I have companies I took public to sell.
Right.
I own the stocks and silver companies public. My stocks, I can. And then we make most of our money from Kenny. Not most of it, but we get income from 13,000 or 14,000 rental units with no equity. It's pure debt. And we pay no taxes. And then we invest in oil wells.
Right.
And we don't invest in oil companies, oil wells. And so when Biden took the Keystone XL pipeline, he cut that project. Oil went from $30 a barrel to $130 a barrel. 400% raise in one day. I actually liked Biden for about 20 minutes.
Yeah.
But unfortunately, as you know, George, the problem is higher oil prices cause higher fuel prices and higher food prices, which is going to wipe out the poor and middle.
Yeah, because they're the people that get disproportionately affected because a higher percentage of their income goes to those things that are going up in price.
And they want to tax the rich, but there's too few rich.
Yeah, well, what they don't... Yeah,
we don't pay taxes anyway.
Yeah, the problem with that argument, I've been hearing that a lot lately. I've been hearing that in Davos.
All the time.
Yeah, we talked about that prior to recording, is the cure for inflation is not more money. That's usually the cause of inflation or consumer price inflation. The cure for consumer price inflation is more stuff.
Yes, produce more.
You got to produce more stuff.
Yeah, produce more oil. Guess what?
Yeah, so if you're just taxing the people who are producing, that defeats the purpose. That's going to create most likely higher consumer price inflation.
That's what Sarah's complaining about is the baby formula. They got so many regulations they can't produce it here.
Well, yeah, everybody's blaming this baby formula regulation on supply chain, but that's not actually what's happening. It's over-regulation.
Yeah, right.
So
we just imported how many millions of cases of baby food? The United States, the greatest nation in the world, had to import baby food. Something's wrong.
Yeah.
Well, look at our trade deficit. I mean, we're importing everything. We're consuming so much more than we produce. But we've been doing that for decades.
We can print money to pay for it.
Right, but we can't print food. We can't print energy. And at a certain point, if those countries that we're getting that from say, you know what, we're not going there anymore. We're not playing your game.
But isn't that what's happening?
Yeah. So a great example is let's look at China starting to do deals with Saudi Arabia.
Yeah.
And I think most likely Russia in yuan. Okay. So most people just see that and they say, oh, it's kind of the deterioration of the dollar. But no, there's far more to it than that. So before that happened, China would need dollars to buy the food or the commodities, the energy they needed.
The oil.
That's right. So they needed to earn those dollars. So that's why they would export all these items that we buy at Walmart because they want our dollars so they can go buy the oil. So they're in a very difficult position there. But if they start doing these deals in yuan for oil, now all of a sudden they can print the currency to buy the oil. They don't have to earn it. You see,
Smart for them.
But what that means is now the United States doesn't have as much leverage over China
Right.
as it once did.
Right.
So China can start gradually. It doesn't happen overnight, but they can start to tell the United States to pound sand. And if we can't get our stuff from China, where are we going to get it? We're not producing it here internally in our domestic economy. So then, where do we get it? We get it somewhere else at a much, much higher price, if we can get it at all.
Well, I'm a macro guy too, but there was a guy named Muammar Gaddafi, and he told the U.S. pound sand also. We're going to sell our oil in dinars,
Yeah.
not dollars, and he disappeared.
Yeah. Yeah.
I guess you don't mess with the U.S.
Yeah, but I don't know that you can compare Libya to,
I understand,
to China. It's a different ballgame.
You don't mess with the money.
Yeah.
And and when we come back, we're going to be talking more about this, because you were talking about the crypto and
Those central bank digital currency.
Central bank and the IMF SDRs and all this stuff. They're playing games with money big time right now.
Well, they're trying to control it. It reminds me of the quote that we were discussing actually the other day from Kissinger. Remember?
What was that?
Who was the main influence
Right.
on Klaus Schwab, who runs the World Economic Forum
I
in
didn't know
Davos.
that. I didn't know that.
Yeah, we could tell that story when
Yeah.
we get back from break if you want me to. But what his quote was, if you control the food, you control the money. Or excuse me, if you control the food, you control the people. If you control the energy, you control countries. And if you control money, you control the world.
That's right. And that was what Rothschild said. I care not who makes the rule,
Right.
as long as I control the money.
Yeah. And I think that's part of their objective. And we hear them out just explicitly talking about it
And
at
here's-
Davos this week.
That's real gold, and that's real silver. This is $2,000. That's concentrated money.
Yeah.
And this here is about $35.
Yeah, but more importantly, this has maintained its purchasing power over the last 5,000 years. So you can buy just as much stuff today with this little gold coin as you could have 5,000 years ago.
And that's why I invited you to come to our gold mine that we bought for nothing down in Utah.
Yeah, yeah.
But it's because we're taught to think differently.
Mhm.
And that's what we teach. The point here is that you are who you hang out with.
Absolutely.
And we talked about it, the gap gets wider and wider depending on who you hang out with. And if you're hanging out with village idiots, guess what? You're falling behind big time.
Yeah. And I'm a perfect example of that because, like we were saying earlier, I retired in 2012, but I didn't start my podcast or my YouTube channel until 2019, the podcast not till 2020. And in the interim, when you're retiring, everyone thinks that life on the beach just sipping pina coladas is going to be great. But that gets old after about 2 weeks, and you can feel yourself deteriorate mentally.
And I was saying to you from Portland, and Kim bought her first rental property in Portland by Eastmoreland, and she found religion. She could buy something for nothing.
Yeah.
In the worst economy ever.
Yeah.
Interest rates were 9%, and people are crying the blues at 5%.
Yeah.
And once you understand that it's all in your head, and you can adjust the dials in your brain, you'll see a different world.
And it's all about that knowledge.
Yeah, and so we have Rel Pell on just now. There's more opportunity today, but people are committing suicide. So what were you saying, Sarah? What's happening with
during
Bitcoin?
During break, we were talking about the future of digital assets.
Yeah.
And I was asking George about Luna, this big crash of stable coins. Millions of dollars were lost.
Now, did I get into an argument on that one?
It was civil.
No, this is George. George, it's a Rich Dad radio show. I'm known for my tact and discipline and all this stuff, my silver tongue. And this, every time I hear it from the
experts.
FNU guys, this will never go down. I mean, how many times have you heard that one? And I'm older. I hear it all the time. So he's yelling about this will never go down, and I go, why? It's got algorithms. I went, oh God. So I started screaming at him. I said, don't give me that crap, and all this stuff. And then 2 days later, boom, goes to zero almost, right?
Yeah, and so it sent a shockwave, I guess is what I was trying to say earlier. And, so does that, are we seeing this trembling of, maybe this isn't the future. And you had a great comment about the .com era.
Yeah, well, I think that it'll
and
be...
the real estate area, too. The same thing happened.
Yeah, I mean, I think it'll be similar in the sense that, back in the late 90s, everything was .com and they were getting these billion-dollar valuations. And it is true that the internet was the future. Yeah, it is true that the internet was the future, but not all those companies. 99% of them go bust. Mm-hmm. And I think it'll most likely be the same with crypto. There will come, maybe Bitcoin, Ethereum will come out winners in the long run and will be here. I don't know what purpose they'll serve. I don't know if they'll be transactional in the case of Bitcoin or be more of a digital reserve asset, store value. I'm not quite sure, what place it'll play, but I think it'll most likely play out the same way the .com bubble burst in the 1990s.
Do you guys agree with Robert and George's opinions? What do you think is the safest investment to help last this economic crisis? Comment your thoughts in the comment section below. Please like and subscribe, and we'll see you on the next one.